It's with my older brother, Brandon Lipman. You got a book coming, mate.
The book's called Speedrunning Capitalism Through Buying Boring Businesses.
That's a cool name. We're going to dive a bit deeper into purchasing a business or business growth and business acquisition.
A buyer, in theory, could buy any business. Seller only has one business to sell. So who has the advantage in that transaction?
Yeah.
The buyer every single time, because there are so many more businesses that are going to be coming up for sale over the next 10, 20 years. We're going to have this new asset class. Borrowing for your first business is one of the most dangerous financial things that you can do in your entire life. I just want to make that abundantly clear.
Yeah. Welcome back. Next episode of the Blueprint Finance podcast. And Rory and I were doing a bit of a revision of, one of our more popular podcasts. I think probably one of the most popular podcasts of last year, because we really scratched the surface.
That's right. Yeah, it was one of the longest of the year too.
Longest of the year. And it's with my older brother, Brandon Lipman. And it's quite timely because there are a couple of things to discuss, but mainly we're going to dive a bit deeper into purchasing a business or business growth and business acquisition, those key things that we just didn't have enough time to really get our teeth into last year, and talk about a few cool things that are happening and how we're structuring some of these business deals in terms of financing them. So, Brandon, mate, welcome back.
Look, man, you can have me whenever you want me.
Mate, we've been trying to get you all year, man.
Yeah.
He's trying to act like it's
Yeah, you're a hard man to pin down. But we get it.
Try me. try and pin me down.
And obviously we've covered what we're going to go through today, but massive development. You got a book coming, mate. You're going to be a novelist.
Yeah, a novelist. Yeah, that's it. I'm not going to be an author. It's a full novelist.
You're doing the PR run.
Yeah, this is the PR run, and it's a short run. Probably like the book printing. It'll be a short run as well, I'm sure. But no, it's been real fun writing the book.
Oh, awesome! And so, but this is obviously the topics in the book. It's essentially what we're going to be covering today.
Well, pretty much. Yeah, the book's called Speedrunning Capitalism Through Buying Boring Businesses.
That's a cool name, eh?
It is. Yeah. And so it's, and what it does is it takes the concept of buying businesses and works it into the concept of capitalism. So there's like a little bit of philosophy on what that is, how business acquisition fits into that. Because normally you think property, you think funds, you think shares, you think financial products, or even crypto, or all sorts of stuff, right, as a way to get ahead. But because there are so many more businesses that are going to be coming up for sale over the next 10, 20 years, we're going to have this new asset class, which is going to fit right into capitalism. But we haven't really covered up how that actually works and what it looks like for the everyday person, if that's something that they want to add to their portfolio or how they plan on growing their wealth. And personally, I believe that it's the best way to do it. And so I sort of build a case as to why it is the best way to grow and build wealth.
Brilliant.
And then, a bit of strategies, planning work, tactics, all that fun stuff. That's like the textbook stuff afterwards.
How long has it been in the making, and when can we expect
the book?
A copy?
I will hand deliver a copy to you. You can pin me down if you want afterwards.
We'll timestamp that part.
Yeah. And so, look, it's probably, so the book is done. I'm now doing the final edits. So I'm making it sound more like me than something I've just sat down and kind of turned into an encyclopedia. So yeah, that's it. So it's all done. It's incredibly basic, straightforward. I'm hoping by end of April.
Brilliant. Yeah. Just make sure when you do the audio version, the audiobook version, you just stick to the pages, mate, because this guy sends me some voice notes. You see these voice notes?
That takes him unpacking.
10-minute voice note.
Where were you when you said the last one? Because it sounded like you were on a construction site.
The thing is I kind of get on the train, right? Like I get on the thought train. I just have to send it.
Yeah.
What I've started doing is I've started sending notes underneath it in text format about what the voice note's about.
Yeah.
So people know how to engage and when to prioritize.
Oh, yeah, that's brilliant.
So how urgent is it to listen to the 10 minutes?
Yeah, because it's actually very, it's terrible of me to demand 10 minutes of someone's time just by sending them a note to listen to it.
Hey, before we get into the episode, can you give us a bit of a what have you been up to? Have you been inquiring businesses? Have you been working on the ones you've got? Has it been focused on the book? What have you been doing?
From where we left off.
We left off. Yeah. So predominantly it's been book focused, right? So that's been the main thing. Like it's an incredibly valuable thing that I want to get out to people so that they can at least have a great starting point. By no means am I going to be the greatest at it, but I know that it's at least going to start people having the conversation about buying businesses and how that fits into growing their own wealth. So that's been a priority. And then, we've been managing the portfolio. So you guys have met Regan. So he's our asset manager. We've been managing everything in New Zealand. We've set up now in Sydney and Melbourne for one of our rental equipment brands. So we're growing in Australia. We're looking for targets there. And then we've got a couple that are in industry that we're looking at here in New Zealand. And it's just the dating game. It's business. But we're going through the process of finding the right targets here and then potentially raising a little bit of money for it as well.
And
awesome.
And when you said about that opportunity earlier, about the next 10 to 15 years, so you're specifically referring to this baby boomer retirement exit, right? A lot of these people selling their businesses now. Is that what you're saying? We're going to see an uptick of business sales in the next 10 to 15 years?
Definitely. Yep. So there's sort of the trigger phrase, baby boomer businesses are coming up for sale. That's the headline. It sounds punchy. We've got people all over the world preaching this, but there are a lot of people who have businesses who are able to have even like a second run at a business career as well. So there are people who aren't necessarily baby boomers. They might be, what are the other generations? Gen X?
What comes before
Is it
baby
X? So who is between millennial and baby boomer? I think it's Gen X. Or Gen Z?
X. Oh, no, because Gen Z is down next to millennial.
Yeah.
Is it?
I don't know.
Oh, my gosh.
We're not.
We're going to have to get...
Look, can you bring that
Producer
up?
Jackie,
can you send
bring that up? Yeah,
so whatever that generation is, they're also having different ideas about how they spend their time. Because they're thinking about longevity, understanding that the stress of owning a business might not be for them for the next 10, 15, 20 years.
Yeah.
And they're wanting another crack at business too. I think that the days of like a 20 or 30 year business ownership career might also be over. So people want to trade them, people want to sell them and move on, and they're all going to come to the market. So it's a matter of who's ready.
Why are you so bullish? Why acquire a business over starting from scratch?
Right. Yeah. The principle's so basic. It's that business, fundamentally, it's a resource-orientated game. So you need a whole bunch of resources to go out and produce revenue, to take care of business, and then bring home a profit. So if you start, what you're saying is you believe that you can gather the resources quicker than it would be to get money back that you put in to actually buy the business in the first place. So it's a very basic trade-off. Like you reckon, okay, if you believe in starting a business, you're saying I can go and put all the pieces, I can find them, I can put them together, all of the pieces, a lot quicker than I can raise money or repay debt that I've used to buy a business in the first place. And so that's ultimately it. Like a business, it's a collection of people, processes, systems, customers, also assets, location, and like there's a heartbeat to a business as well. So that needs to be established for it to be operating and running and working. If you buy it, that job's typically, most of the time, it's already done.
You just get a huge head start, don't you?
You do. There are negatives to it, right? Like you end up potentially carrying debt. You inherit a lot of expectations that previous owners might have set. You inherit bad stuff that you might not necessarily already know. I think predominantly the riskiest part of it is taking debt.
That's a great point. So the biggest consideration, obviously, you put it that way, it's a no-brainer, but do you have the capacity and stomach to service and repay the debt in the long term?
Yeah. Ultimately, it's the most volatile asset class that you can participate in.
Yeah.
But because of that, it's the highest ROI as well, and it can afford you the greatest life too.
Yeah. You got no problems financing with debt though, are you?
Well, it depends what the business is, right? I'd have a problem if it was not a good business.
Yeah.
But I guess if you do, the reality is there's no perfect business in the first place. So you're going to buy stuff that's going to bring you difficulty. It's not all, I don't want to go painting a picture like this is just, you walk into the business shop, you pick one off the shelf, you ask the person selling it, oh, what is this? What can I try this one out?
These are the numbers.
Yeah, hard to return it. Very hard to return a business if you've bought it And so once that's done, you're left holding it, and you've got all the obligations that come with it. So yeah, leverage is it can be the most dangerous thing, because that's normally what sets off the cascading negative effects that come. You don't pay. It's normally, and the process normally is if you don't have enough money, then IRD doesn't get paid. Then when that doesn't happen for long enough, they come knocking on the door and it pulls in everyone else who you owe money to. So normally by the time that happens, you're already off the cliff. You just haven't realized it.
Talking about building a business for profit. So really trying to help our viewers understand, when you're buying a business, you have to already be thinking about the exit, right? Because you can't go in just saying, oh, I'm going to pay myself whatever, let the expenses float, and whatever I make at the end of the years, that's it. You need to make it marketable from the start so that in 10 years or 15, 20 years, when you look to sell it again, when it's your time to retire or exit, you've actually got a business and it's not just a lifestyle business built by the owner. So explain a bit about that and how do people make that the main thing, number one thing?
So you're asking whether or not, or how people create the business so that it's something that they can sell in the future.
Exactly. So say we've found our finance, we've found a good business, we've bought the business. Now what do we have to think about in terms of the next time it gets sold?
Sweet. So as a buyer, the first thing I'm normally looking at to assess what I'm going to be going through as the new owner of a business is I look at the lifestyle. And I actually start with lifestyle. So I look at the lifestyle that the current owner has, because all you're really doing is just swapping places with the owner, assuming that you don't do anything else to the business. So you can have a plan and you can have all these ideas that you want to bring to the business or that you might want to change about the business or implement. Now, the results of that are not going to be certain until you've done them and you've seen them. So you can't bank on the fact that things are going to change for positive. So whatever state you buy it in, that's kind of the state that you have to accept it in. And you're going to be rolling the dice on anything that you want to do to the business for positive change. So it's not always guaranteed. And I think that's one thing that you can get oversold on if you're wanting to buy a business, is reading a memorandum, looking at it, and it's a long form sales page document. And so there's a lot in there saying you can do this to the business, you can increase the marketing, you can change this, you can change that, all things which are just incredibly easier said than done. And so from a pragmatic perspective, you have no evidence that doing any of those things is going to benefit the business. So that's the first thing, is I kind of look at the lifestyle and say, okay, is this something that I'm going to accept in its current state? Because the end result that you can be sitting with is the business for 20 or 30 years. And you have to be ready to accept that. Obviously, there are other things that can happen which are more negative, like you might wind it down or you might encounter really difficult scenarios to trade in. Of course, you can run into that. But assuming that you're buying it and it's going to go to the distance, you want to make sure that you're happy with the thing that you're buying and in its current state. And any magic or anything that you want to perform on it afterwards is it's you're the one rolling the dice. You get the benefits of it. And yeah, so that's where I'd start. And the second thing that I would do is I'd be focusing.
Before you do the second thing, can you just expand a little bit on the lifestyle of the owner? Like, what specifically are we talking about here? How involved they are, like how much spare time they've got?
Pretty much.
Like, is it also if they're running personal expenses in the business?
It incorporates absolutely. Well, it's all of that, right? So I would look at the owner first, and I'd look at what lifestyle they're currently living. Are they spending plenty of time with their kids, with their family? Are they going overseas, or are they doing 90-hour weeks and kind of suffering from health conditions? Because the business can be the precursor for that, and it's seriously how it can look.
Yeah.
So, and I've sat plenty of times opposite people who are wanting to sell their business, and there's two camps. There's the person who's chill, who comes in, does the work. It's maybe 20 hours, or it's maybe a really light 40 because they love it. Drive a nice vehicle, get time overseas, get time with the family. They don't seem and have actual clear signs of stress. Or you have the other side where it's, hey, I'm selling because this business is
killing me.
Yeah. And those cues are actually far too obvious to ignore. which is a real shame because that means that there are people out there who are in this position where their business is actually sucking everything out of them. So you're not the ambulance at the bottom of the cliff if you're a buyer. You get to, again, you're trading places with the person who you're buying the business from. And if they're suffering from stress-inflicted health conditions, then you bet if you don't change anything that could be you.
And I imagine that the less an owner impacts the business, potentially the more valuable it is in terms of like their involvement.
Well, at that point, I think you've actually then got a business.
Yeah, as opposed to the glorified job.
Yeah, shouldering all the responsibility and needing to get the job done solo. And that's the thing too, like if a business owner is wanting to sell a business, I would argue you're not selling a business at that point. If you're the one doing all the work, you're handing something over. It's not you're not selling a company, you're selling obligation.
Yeah.
So from anyone who is wanting to sell a business or prepare a business for sale, they'd want to make sure that they've done everything so that the next owner can step in and own it rather than be owned by it.
Yeah.
So it's like putting yourself in a buyer's shoes and trying to answer those questions in advance. You know, how much time do I actually spend on the business every week? You know, how much of the revenue, if I wasn't around, you know, are my roles in the business so specific that I can't be replaced? Those sorts of things, right?
Exactly. And they're very hard to that's actually one of the easiest things for an owner to fudge.
Yeah.
So you really have to look at calendar management and understand what they're doing at all times during the week. If you can pinpoint tasks where it seems like some of the staff members aren't really doing like any of the actual management tasks of the business, then the owner is doing it.
Yeah, exactly.
Dan sort of touched on the long-term view of, you know, your plan as you go into buying a business and having an exit in mind. Is that sort of your mentality around a business? You know, you're thinking about how does this business look like when I want to get out of it, as opposed to the pure lifestyle business, you know?
Yeah, I think you've always got to be ready for it. And that's one lesson I learned from one gentleman who ran like a big logistics company a long time ago. And he told me once, we were actually in a meeting because we were talking about a mortgage with him. And he ushered me out of the meeting because he got a call from this guy who had always been calling him saying, hey, look, I want to buy your business. And after, he sort of rushed me out pretty quickly because it was he was the owner of his logistics company. And so it seemed like this was a really important call for him. And then afterwards, he pulled me aside and he said, I'm really sorry that I just kicked you out. It was very rude. But he said, you just always have to be ready to sell because you never know when the right moment is. And you might have to, but if you're not ready for it, then you can't actually take advantage of it. That moment doesn't arrive very often. I think that's the thing that a lot of business owners or current business owners might have, is that they think that selling a business is as simple as going and taking it to it's sort of like a cash converters for business. Like you put it there, you throw out a trade me ad. Literally, you throw out a trade me ad, and you just imagine that there are all these people who want to buy your business. So, and from like a market perspective, a buyer, in theory, could buy any business. Seller only has one business to sell. So who has the advantage in that transaction?
Yeah.
The buyer every single time. But what's interesting is the buyers are not empowered. And because the buyers aren't empowered, they don't actually see that they've got this advantage when they can buy anything. And because perhaps they're not business owners, they haven't gone through a business purchase before, they can easily be told by business brokers that they actually don't have the advantage, or that this is, or they can have. Manipulation isn't the right word, but the sales process can be designed around to look like the buyer's the fool, where really it's the seller who is actually in a very weak position when it comes to selling a business. And so when you own it, you're actually holding something, like I've said just now, you're owning something that's very difficult to sell. So you have to make it very attractive to buy.
Yeah, for sure. Actually, do you know any sort of numbers around the market in terms of businesses for sale and potential buyers?
Yeah, so they're loose, not so much about buyers and businesses, not so much how many buyers or what the buyer pool is and how many businesses there are. But one stat that you can hear colloquially referenced is that it takes 80% of businesses won't sell. And of those 20, it will take anywhere from 9 to 12 months on average for a business to sell. So it's kind of like, to put that in other terms, it's like you've got 1 in 5 chance of getting a date to the school ball, but you're only going to find out in 9 to 12 months.
It's not a very good ratio, eh?
Is that really true?
If you're going to try and,
don't.
if you want to take someone to the school ball, you got to plan in year 11, right? So you got to put in a lot of work beforehand in that instance.
Wow.
That is crazy. Is that really true? 80% don't never sell.
Yeah, and I think that's just from general listings.
Yeah.
So a lot of listings will be
Private.
it'll be very small companies that are pretty difficult to sell in the first place.
Yeah.
Not saying that 1 in 5 businesses are worth buying. So that's not like a stat that people should be working with. But the quality ones definitely do sell. They don't hang around. They do go. But you need a quality business in the first place.
Yeah. It's so interesting because, even with property can be really tough to sell sometimes, and you got benefits of things like comparable sales and all that sort of stuff. So imagine a market where, lending's not as straightforward, and then there's so many variables,
Yeah.
So thinking of all those things at the start on your way in, when you take on that obligation of being a business owner, is massive. How am I going to make this a sellable business?
Yes.
Yeah. That's brilliant. And Rory and I were just talking when we were planning this episode is obviously when you do look to sell your business, there's multiples that people consider, and talking about the multiple. So like people often talk about valuing a business, in a sort of general sense at maybe 3 times or 4 times the multiple of the EBITDA, right? Which is the earnings before interest and tax. So considering that, I mean, why do different businesses, are they able to have higher multiples, as part of the expectation? Like what is the variance going on there and why is that different in different industries?
Yeah, there's a lot of context with this. So the multiple value, the way that a business traditionally is valued, and when I talk about business valuation, I'm talking about, let's say businesses less than $1 million in earnings. So let's say if we go anywhere from, let's say $200,000 in earnings up to $1 million in earnings. Within that range, you can pretty much work to a multiple valuation. There can be some other ways to justify valuing a business differently. It isn't as much of like a voodoo act. It's like what people really think it is. The reason why is because, again, you're buying a volatile asset, full stop. So you have to understand that that's what you're buying, and you can increase the multiple that you're paying based on a reduction in risk that you're taking. It's like the headline, right? So it's just, if it is less risky, then you can afford to pay slightly more for it. There's no such thing as like this business is just in like an in-demand industry, so the multiple valuations are higher.
Yeah.
That's stuff. Those are sales tactics.
Yeah.
All right. So like obviously this is going to make me a business broker's worst nightmare, but like these are sales tactics, right? I've seen businesses with listing prices that have been more than halved, right? Like it's just the way that the cookie crumbles for businesses that come up for sale. So it really starts with quality. So we start asking ourselves, what makes a business high quality? So if a business has diverse customers, it has established ways to hire staff members, established ways to train staff members, systems, processes, all the stuff that's all people say is boring and that you kind of need to have in place so that you've got a company that can run. You've got that. If you've got a higher profit figure, or if you've got better cash flow as well, that's also something that will increase the value of business. And then some level of management that puts a line between you as the owner operator and the business being managed, or having some management inputs from people who aren't the owner. So if you have those things, then you can start to push the multiple higher. But as it gets a lot lower, then you really start to find it hard to justify why you'd pay a high multiple for a business that hasn't given you, that's actually got a lot of risk.
Yeah, fully understand. And is it the type of income that these businesses earn can affect the multiple? Like, for example, if it's a subscription-based business, I know that sometimes that can be a thing, or
there's some value
really.
to that. There is some value to that, right? And I think there's value to it in the sense that you know that it's going to be repeatable from a subscription-based model as well. You've normally got a lot of people who are paying the same amount, so it's diverse customers, right? Which is good. I think that's the thing is you want diversity within every part of the business. So diverse customers, diverse ways to get the customers, diverse people to hire, or a diverse strategy to find people who can hire, who you can train to do the thing, and then higher income, and then someone to help manage it. Like that's kind of like the mecca that you're trying to reach.
So
it's
good.
always a case by case basis, eh?
Yeah, every time.
Because
and you're never going to find something that's perfect. There's always going to be something about it. Like you might have one customer which does make up a substantial amount of the revenue, but it should never be overweighted towards that customer. It shouldn't be a business that just serves that customer. For example, you look at Fonterra, like we really just serve like China as like their main, like China is just such a large customer of Fonterra, which we have so many farmers who are obviously farming to then on sell over to China. We have a lot of risk. That's probably New Zealand's biggest risk. And so it sits within a business. You can find those scenarios within smaller businesses too.
That's so good. And for these business purchases that, you see the listings and you see a price and you think that's too good to be true, or it's such a good deal. What are some general red flags that you'd see maybe on the profit and loss or the balance sheet that would tell you why it's so, well priced or fairly priced compared to its other?
Yeah.
Do you need a good accountant as well?
You want to get
out for little shifts in the books.
Yeah. Some creative accounting.
Just seeing if it was put 180 on fan bake for 30 minutes. Those are chicken steaks, by the way. Nah, yeah, definitely. You want there's this topic called quality of earnings. And so like a quality of earnings report looks at the revenue that you get and how it's obtained, and obviously establishes the quality of it. So if it's consistent, if it's from diverse customers, how it's sourced, what tasks or attributes actually return the earnings as well, you can actually assess whether, and in the quality of earnings, whether or not it's legitimate or not. If it reflects the right reporting period too, there's like a full examination that you can go on that you can, and different accountants will do great jobs or different quality jobs on a quality of earnings report too.
Yeah.
So that's one thing that you can do. But yeah, like the key one is always consistency, and like things just being out of kilter, and it just being a really either large expense or really big drop in revenue or really big increase in revenue that's not explainable, or it's just assumed that life is going to continue to, or that the business is going to continue to operate that way, because it isn't going to be guaranteed to do the same thing each year. So you want to aim for consistency. Like a consistent business over 4 to 5 years is worth its weight in gold. And that's probably another metric as well to consider for what would drive value, a multiple as well. Consistently doing the same thing with a diverse group of customers, systemized, high profits, management in place, or some level of management in place, and a way to keep the ship going.
Nice. Buying a business. This is sort of looping back to earlier in the combo, but you mentioned like the risks of debt and your expansion into Australia and potentially getting investors and whatnot.
Yeah.
What is the investor pool like, and how do you make that attractive, if you want to avoid the risk of debt?
Yeah, so if you're going to raise capital, you really have to have some kind of, first you have to find the right person or the right people who are going to be aligned with the journey that you get on. So what you don't want is what I call love money. So love money is going to people who love you to then ask them for money, because that's typically not a business-based decision, or there's typically not skill involved in shelling out the money.
That's good.
Yeah, where what you can do is offer that seat to someone else who's actually very skilled or has probably run the race before, and is actually going to be more of like a coach, or actually wants to help guide you on your journey forward as an entrepreneur or a business owner. Those are normally people who have owned businesses before and sold them, because that's maybe the thing that you want to do too. So it makes sense to find someone who wants to go on that journey again, but not actually do it in the driver's seat.
Yeah.
Yeah. So kind of like how in the Hunger Games, they have their mentors. Was it Woody Harrelson for Katniss?
Yeah.
Probably not a Woody Harrelson, but
less. He's an alcoholic in that one.
You probably don't want to find that guy. But you probably want someone closer to someone who's going to be able to see the road ahead.
Like a Matthew McConaughey.
Exactly.
Yeah,
and he's narrating it for you too.
Yeah.
Exactly. Yeah.
That's so good. Our market is the real estate market's very, very much impacted by trends and economic, movements, unemployment, high interest rates, all those sorts of things. Do we see that even more so in the business market for purchasing businesses? And also, does that mean there's really good deals at the market?
Yeah, I think people are flocking to look at businesses for sale. I would think we probably need more stats on actual transactions completed, but it seems like that number is naturally going to grow. And it's not so much, it's probably a matter of the fact that there are more businesses coming to the market because we're entering this age of the golden age of this wealth transfer thing. We're in it. We're living it. And it's the best time to be alive, right?
Yes.
And so it's already started. So I would expect that we're going to see more businesses come up for sale. I'd expect we're going to see more people want to buy these businesses. And I'd say from an economic perspective, it's actually really hard because if we haven't had a good economy over the last few years. That means that when you come to turn in your report card, the P&L and the balance sheet, it's not looking too flash.
Yeah.
Which means that when you take the business to the business shop to sell it, you're not going to get the valuation that maybe you maybe had thought you were going to get earlier. So there might be people who are holding out on it as well. Like I think people who have businesses that they're happy to stay on, and this is the other thing, building for the long game. If you could stay over the last 7 or 8 years and continue to hold on and draw profits and maintain the business, and you've got something that you built to go the distance, you might be 2 or 3 years away right now from your exit. Whereas someone who was on the ropes and needing to sell and desperate, who wasn't prepared, they can't weather economic storms. And so that's again why you kind of want a long-term, like a medium or long-term vision of buying, but also selling.
100%. Touching on what Roy was just talking about financing versus investors. So this is a tricky one, right? Because if you do it all yourself, that's great. If it goes well, you get to keep all the cookies.
Yeah, huge battle.
But then, the debt's going to be a bit more expensive. So like you said, weigh up what's worthwhile, avoid the love money stuff, and avoid getting into situations that are just not going to be fruitful. But is there a benefit into taking investor money that is, a non-active shareholder? If you know what I mean?
Definitely.
Yeah.
Yeah, especially because it's going to allow you to punch up a couple of weight classes.
Yep.
If you think about the route that I did everything off the back of
so you just borrowed debt?
Yeah, so initially the first few deals that I'd done were no money down. So what I was doing was buying all these small, crappy little assets and trying to make a big business.
Yeah.
So I did it, and it was actually quite difficult. And so how I could have done it a bit faster was actually raise a little bit of money from a private investor or someone who wanted to be an equity partner, and then bought a slightly bigger business and then actually operate and start with like a really solid base. Now, last deal, that's what we did. And it was just such a dream to get into a new industry, operate within it, something really solid that we could use to bolt other things onto. And that was a dream compared to going solo, debt, and doing no money down deals and trying to build a big asset that way. It's like night and day, the difference. So I think it can be very alluring to go and do it by yourself. But I think if you have the right person, like the right investor in your corner, the right person with equity, the right team, you can punch up and you can just buy great stuff. And you're just at peace, man. Just at peace.
But you've done your time, and there's a bit of learning and grit and apprenticeship work and those tough starts, right?
Right.
Like it's not as easy as just, go and find a good business to buy and get an investor, eh? Like sometimes life's a journey and you've got to plant a few seeds before you see any growth, eh?
Totally. Yeah. It's the concept of like, how people go out and collect, it's going on social media right now, dad law.
Oh, yeah.
You've heard of the concept.
Yeah.
It's commercial law. Like you go out and collect like the journey and like the scars and everything that are hilarious. And then they can, obviously, they give you all these experiences which make you highly investable. So it's interesting. It is a chicken and egg sort of a balance, right? Like, how do you become investable without having like the clear quality and capability of being investable? So it's trying to figure out a balance of how you do that.
Because that's where you're at now, right? And your personal business is you've got a successful model and you're looking to expand. It's a much easier pitch.
Exactly.
You know, it's like the formula works here. Let's take it over there, bigger market. You know, why not?
And it's just one step at a time, right? And I think you're just being fearless and making mistakes. Like, you just want the big mistake is just a knockout punch. That's when you get caught with no money and like several bad things happen at the same time, and you can't play defense from that position.
I think the old boys call it losing your shirt.
Oh, is it?
When you lose your shirt, you know?
No way. Well,
I just heard a lot of older Kiwi entrepreneurs, they talk about when they would do a bad business deal, they'd wipe them out.
Yeah.
And that's called losing your shirt.
That's so funny. So internally we have a shirts off Friday between.
Well, if that's a day off, that's fine.
Oh, well, no, we're working. Yeah, we do shirts off Friday for our meeting. So I kind of, you know, we might have to just
confirming you only have men in this. It's just a couple of guys. Man.
Yeah,
cool. So there's not ladies in the.
Oh no. Yeah, this is very much like that. We're dealing with business managing the assets.
Yeah.
So it's not internal. It's just Regan and I. So shirts off.
Two guys.
Shirts off. Two mates. Shirts off Friday.
Oh, that's brilliant.
Well, next time we have you in there, we'll make sure it's a Friday.
Yeah, dude.
Yeah, the listeners will enjoy that. Do a shirts off podcast. Give us a couple of months, you know, for those New Year's resolutions.
Well, we'll see you on the next IROX.
That is right. This should probably be an off-the-record question, but speaking of my own growth, are you interested in perhaps financing an insurance book?
What's the book?
Yeah, true.
Yeah, more details.
This could be a good case study.
Yeah, that's right.
Yeah.
All right, I'll come back to you on that one.
Yeah, cool, man.
So following on that comment of losing your shirt.
Right.
So the idea is that when you're focusing on these expansion moves, you're never sort of staking the whole.
Yeah.
You know, you're never stretching yourself to a point where if I make the wrong move here, I'm going to go bust.
Yeah, it's kind of the concept of, moving just half a step slower than what I think you need to go.
Yeah.
And then at some points, I think you know that it's time to throttle it.
Yeah.
And that's where we kind of got to at the moment, where we've come off the back of like a pretty average few years in the New Zealand economy, got a little bit of money, and we just thought, all right, maybe we don't go buying just yet, and we go for organic growth, and we just rip straight into Australia. So it's a way for us to get a higher ROI on our capital, but also play defense, where we're not staking everything.
Yep.
We're doing something that we know works without needing to raise money for it. We can use that as a revenue driving activity, and we bring home profits.
Yeah.
So it's kind of like you try and look for strategies that are going to hit two birds with one stone. And if you can pull it off where you're playing offense and defense with like a small decision like that, and you're generally not staking everything, but you're taking very calculated risks based off everything that you've seen. You just don't get left with no cash in the bank account. And that's ultimately the biggest risk to any business, is its cash flow. Most businesses are horrific with cash flow. But when you finance a business and it's got bad cash flow and it deals with a couple cheap shots, you have nothing in the bank account, it can cost you the company.
Yeah.
You're left holding the bag. So a great way to self-insure against bad things happening is having money in the bank account.
Yeah.
And just having cash.
And just not taking the profit from the last year and then letting that roll over. And yeah.
And you think about the pathway to continue to grow a portfolio. If you're buying another company, the great thing about that is you're not needing to take money out of that next company to service your livelihood. So when you come to like looking at servicing with banks, for example, it changes the playing field incredibly, because they're no longer factoring in personal income needing to come out of the business or the second business that you're buying, because you're already covered with the first.
Yeah.
Obviously, you'll need to make allowances if you're needing to hire more people to put them into that business, or if you're needing to change the P&L, and that's smart. But it's once you get over the first one, then if you've done something smart, like what I normally suggest is just keeping all cash that you get, really not paying yourself, like really not letting money fly out of that bank account for maybe 2 years.
Yeah.
And that way, after a 2-year cycle, you've got the business under control.
And you understand the cycles of it. And
you understand the cycle. You know what a year looks like. You can deal with like an average year. You can get back on track for year 2. But then you come back and you've got money in the bank account and you can go on and buy another business. You've already understood where perhaps you maybe made some mistakes in your first acquisition. You're out there buying another business. If you buy a good business, you're buying cash flow.
Yeah, exactly. And so it's just making the most of what you've got, right?
Yeah.
You know, and I often will meet investors or property investors who come to me and they've found a deal and they say, how do you finance on this? And we say, hang on, hold the fort. You know, we sit down, we do the strategy session. We say, look, you know, why are you actually buying this property? What are you trying to achieve? And you start to realize that, you know, they've got this equity and they just feel this need, like I need to do something. You know what I mean?
Deploy.
Yeah. Well, it's like, hang on, actually understand why you want to invest in the first place and what you want out of it. Because this purchase is just going to screw your cash flow up, or it's just not the right move for you based on what you're trying to achieve. So I think that's a big thing, is that investors or entrepreneurs that we've seen, they just feel the need to keep growing or try and grow out of, you know, unsatisfactory earnings or unsatisfactory position where it's, you know, that's the wrong time.
Totally. And speaking specifically to business acquisition, I think that the main thing that we look at first is obviously the money that you get from buying a business. Like that's where you get drawn in and you're like, yeah, look, I can go and buy a property for $1 million, or I can go and buy a business for $1 million, and look what's different. You can hit a 50% yield on a business that's been sold for $1 million, or you can hit maybe a 5 or a 4 or a 3. I don't know.
Nice. Yeah.
So you've got the yield conversation, right? So that attracts you to business, but the money can't be the main driver. Just like anything, if money is the main driver, it's obviously one of the most important drivers, but it can send you on a goose chase where you end up looking at a business and just not thinking like how much. For example, you can buy a business that can tactfully allow you into rooms that you couldn't get into before, that you're going to meet people who you otherwise wouldn't have been able to meet before. That's going to continue to push you in a direction that you may want to hit. So if you know why you're buying a business in the first place, you can think tactfully about what kind of business you buy based on the life that it should give you and the people that you're going to meet.
Yeah, that's a good point. Last time we said one of the big topics we want to chat about in the second podcast was about actually financing business deals and what that looks like. So, you know, we're addressing now the crowd of our listeners. That's probably say 95%. There's no rich Uncle Mortimer in London who's just passed away and left us £10 million. You know, we've got to figure out a way how to finance.
We got to get them. Heard that we want to keep all the eggs in the basket for 2 years.
Right.
Yeah.
No income.
Exactly. We're living with the folks. We're living with the folks. We're not, we're not concerned about making a ton of money. We just want to finance this next deal properly. So
you're right.
If we can go through different tiers of how we see business deals get financed. Obviously, it's a very different world to property finance. People love property finance because, just like we said at the start, it's such an easily transactable asset. There's comparable sales. You know, there's real estate agents love selling the things and just flicking them off, and people buy them and they need to live in them, right?
Yep.
So lending against property, that's your cheapest possible rate you're going to get and doesn't have other adverse risks.
Right.
Now you talk about business ownership. Even if you have a property that you can lend against to get the money for the business, your rate's still going to be expensive.
Yeah.
Why the hell is that? You think I've got the property here, can sell it, but it's because of what I just mentioned, right?
Yeah. Exactly. Yeah. Like you're ultimately taking a lot more risk. For example, the bank's not going to know whether or not you pay GST or whether or not you pay your tax on time. What other debt could be cooking afterwards, right? You can have all the agreements signed that you're going to tell them and that you should be, and the banks will ask you to do more frequent reporting depending on how much you're holding.
Yeah.
But the reality is once that's done, more obligations can come out. So they're not only insuring just against like the $1 million you're borrowing, but maybe like another 200 or 300 that you could easily tick up elsewhere based on other other activity that you take in the
So
business.
true. And they don't know if you're a cowboy. They don't know if you're going to the builder site and you think PPE is a recommendation, not an obligation.
Yeah. And your no shirts Friday. That's the other thing.
Yeah,
They
you're
don't
welding
know
with
about
no
it.
shirts on. Yeah.
So exactly. It's just this level of like extra risk
100%.
that people can't that they won't ever see.
Yeah.
And so they price it accordingly, but then over time those rates actually drop and they can start relieving you of things like the personal guarantees that you have to take when you're going down the bank route.
Well, tell me about that, because that's exactly how the banks view it. I guess it's for self-employed borrowers as well, is that when you want to start out, it's a tremendous undertaking for the lender. They're taking all the risk. That's why it's priced so hard. That's why actually getting finance to start a business is very hard to get, But once you got your 2 years running and they can see you doing well, the table's completely turned, There's lenders out there happy to finance you. What's called, unsecured lending, or just a GSA, a general security agreement on the business. So it's essentially unsecured, but it's secured by the business, right? And then there's such a large market for that,
Yeah.
So why is that? Because have we eliminated that risk?
Yeah, it's operator risk.
Yeah.
Yeah, it's just simply down to the actual person and how they manage the business.
Yeah.
The principles are so simple. If you buy a good business that you don't need to do anything to, and it's got evidence that it's continued to do the same thing, and there's no glaringly obvious risk in the future that will change when you own the business. If you perform, if you don't take money out of the business, you should be all right. Now, the issue is just in the things that you don't see, which also the bank doesn't see too. But if you're a set of hands that the bank can trust, then they're going to want to continue to fund you, and they're going to want to make it easy for you to borrow, because those are their prime customers too. You end up in different parts of the banking world. They make it easier for you to borrow. They make any kind of maneuverability around property finance as well easier for you too. You crack into a whole nother different area of the bank's vault.
Yeah. When you're a business, borrower, and you're in the bank's corner.
Yeah.
What sort of rates are we getting here?
Obviously, so let's say I'm like
you're a top dog. Yeah.
So like mortgage rates or business?
Business rates.
I think most people I know who are borrowing at business at the moment is sitting like plus and minus a little bit on 8 with a main bank.
Yeah, that's pretty good.
And that's
plus or minus a little bit.
That's small to medium-sized business.
Just secured by the business, no other assets. They're normally sitting around 8, but that can obviously go down or up. So when we started our banking relationship, we started coming down.
Yeah.
So, and that's what we had. I kind of floated like a couple crazy ideas with the banks about how we can start securitizing it with real estate. And then when they asked me, similar to how you'd ask your clients, like, what are you trying to achieve? I explained it to him. He then broke it down for me, our banker, saying, well, we can bring you onto mortgage rates, move things away from security as long as these metrics are met. So relieving PGs, bringing down rates to match or be closer to mortgages are possible, just not off the rip.
Yeah, 100%. And like you're saying, if you throw a property in there, just as a standard rule of thumb, you throw a property into that 8%, you can get that down to about 2%, something like that.
Yeah. And so I'd heavily, the borrowing for your first business is one of the most dangerous financial things that you can do in your entire life. I just want to make that abundantly clear.
Yeah. We don't want to make it sound fun.
Yeah. I don't want to make it sound like two brothers are sitting here and like we're just chatting shit about.
I mean, it's dangerous, but that's the fun, isn't it?
You gotta
take a risk.
Yeah. Look, you gotta.
Yeah.
You wanna make it not a dice roll. You want the odds in your corner.
Yeah, the most calculated risk you can probably take.
Yeah, definitely. But you're playing with fire. Like you can make that work, but you have to respect it. You just have to give it utmost respect if you're going to borrow to buy a business.
That's the respect. That's right.
That's it. You can't disrespect it. You can't get high on leverage. You can't treat that. And that's why I say if you're planning to not take money out of the business, people might think that that's barbaric and tell me that that's stupid. How am I going to feed my children? How am I going to pay for this? How am I going to pay for that? You're self-insuring yourself against one of the most dangerous financial decisions that you can make in your life
100%.
to give you the best possible the best possible chances of having the most upside that you can have in your life, as a financial life as well.
It just reminds me of that quote our investment advisor, Jono, always says, taking risks feels onerous and investing is expensive. But wait until you get the bill for not investing.
Exactly.
Yeah. So everything is a risk. Staying at your salary job or pursuing a career that you don't like, or your income is not where you want it to be, is a risk. So exactly what you're saying. Calculate risk is the number one thing.
Yeah, and if you have an eye and you have a plan to learn through the journey, right? Like if that's your goal and you're saying, okay, well, I'm actually going to walk away with this with so much more, and just don't tie it to money. Like just don't put the money thing on the table. Don't do it for money purposes.
Yeah.
If you tie it to the kind of person that you become and the kind of things that you end up learning, then you realize that you can lose everything, come back, and you're probably going to go twice as hard and do it twice as better.
Yeah.
So not saying that you want the negative things to happen.
Yeah.
But if that happens, as long as you don't give up, you can't lose.
Yeah, exactly. So Brandon, we finance the business.
Congrats.
We're in the business now.
Yeah.
And a great thing we've seen and talked about you with your businesses and anyone who's buying small businesses to sort of, improve them. You're looking at the systems, you're looking at things that you can change instantly to improve that profit margin or just to improve the business in general. What is like a key KPI that you find in these businesses you jump into, hire business or service business? What is the key one that you jump into? You say, if I can improve the KPI, I'm going to change the business. I'm going to really improve it.
There's only one, and the only KPI is if you can find another business which is similar to it that you can buy. Because you grow by the size of a business by buying a business, right?
Yeah.
Well, there you go. So if you're buying in an industry where you can find another target, and you've taken a pathway that you can self-insure growth.
Oh, I understand. Okay.
So that's it. So I'd just be, that's the KPI.
That's your KPI.
Targets.
But that's your KPI before you buy it though, right?
Yeah, well, when you're in it, you got to keep looking. That's the number one. If you're owning the business and you're trying to think about the one thing from your question, what I gather is you're wanting to try and find the one thing that can fundamentally change the business that you've just bought.
Yeah.
As buying another.
Okay.
So what you're doing is you're finding another business which is similar or similar enough that can operate either tangentially, alongside, or with.
Yeah.
So it's either a competitor, a supplier, a customer, perhaps in an industry where there are a lot of similar businesses. If you can get two, obviously you need to map out what running those two together would look like and the team that you'd need and what you might need to change. But then over and above marketing, over and above winning a new client, over and above all of that stuff, you then have a higher likelihood of growing the business by the size of another business by focusing only on that. And obviously just everything else, what you want to do is just keep it the same, because what we've done is we've told all the listeners that you're buying something which is great today, which should be great tomorrow. You're going to have a couple ideas, right? You can have a way that you might think we're going to market differently. We're going to pursue these clients. Here's a few quick wins on the board. You might be in industry. You might understand a couple things. But if you can find one more to buy, then I've said it, you've grown by the size of a business. And that's the KPI.
That's huge, mate. But now you got to go 2 years without earning.
It's another 2 years without
earning. Not only are you buying your first
that's
business,
great.
You're debt financing, and you've got to have an eye on the second business. This is a great mindset, and I love that, by the way, and that's good advice. But I wonder, you mentioned about buying problems, and this is along what Dan was saying. You're always buying some problems, but there's some problems that maybe aren't so bad that you can see that I can turn the crank on that, and not buying a second business. But do you know any of those off the top of your head?
So problems that sort of
efficiencies or something, like that.
That's what I was getting at. But you made a great point.
Yeah, look, I mean,
but that's not what I want.
Okay, he's just sending me back to the back in the bag. Okay. I can't leave this room until I give you
because we just we understand we're buying a business in a competitive market. There's other competitors that you could buy eventually.
Yeah, okay, cool.
But you just come in here. Someone's leaving the business. You can see their heart's not really in it.
Cool.
They're leaving the business. What are the things that you look at? I'm saying this because I've spoken to you about this when you did it, and there were things that you'd change,
right,
and improve you know?
Cool. I mean, look, we've got a whole bunch. We could do, I'll tell
What's
you
your
what.
favorite? What's
my
your fun
favorite?
one?
Okay. So my favorite's finding out the gross profit margin of the business.
Yeah.
Right. So the gross profit margin is the gross profit figure is the number left over after incurring all the expenses that you incur to do the thing.
Yeah.
So let's say you buy, let's say you buy Gidget A. It costs this much, or you sell it for this much. You have all these expenses that come to deliver it or to get it to whomever, and then you have the money that's left over.
Yeah,
that is one of the most important figures that you must know in the business, and it shows up everywhere. So, for example, let's use just something really basic: cleaning, office clean, right? So you want to go and clean an office. You know that the average office is going to take 4 hours to clean with 2 people. So it's 8 hours, right? And you're going to use some you're going to use some cleaning stuff as well too. So you're going to consume that. That's what you're paying. So all you need to do is figure out how to charge more for the services or pay the same amount to affect the gross profit figure. Every dollar that you can increase that number by flows straight through to the bottom line. So it's playing that game, is looking at every single thing that you're doing in the business, how much you're charging for it or how much you get paid for it, what you pay to do the thing, and then making sure that you change that number. That's the number one number that you'll change, and every dollar will flow to the bottom line. A real lazy way to do that is to just increase your prices. If you increase your price by $10 and every month you sell 1,000 things, then you get $10,000. If nothing else has changed, another $10,000 will come to the bottom of the P&L. So that's my favorite one. There's plenty of different ways to do it because it's a real problem. It's a nice little problem solve to figure out, okay, how am I spending and what are we doing? What are the things that we're doing costing? How much are we getting paid for it? Do we need to charge for it? Should we increase prices? And you might even lose some customers on it, but typically those are the customers that you don't want anyway. So then your operation means that you might make the same amount of money, but you'll be doing less work and getting paid more for it. So I've got maybe another 9 of them. So maybe next time.
Teeing us up for a 3rd episode.
Yeah, if you let me out of the room.
Mate, we said we'd keep this under your High Rocks time, which was an hour 40 if anybody's interested.
There we go. Yeah, outs me. You wait for 12 months, man. I want to see you do one now.
Awesome, Brad.
No, that's a great effort, mate.
Cool.
Yeah, mate. Thank you so much for coming on.
A blueprint pleasure, man.
Yeah, and we're so excited for the book. I mean, it's going to summarize, it's going to, no pun intended, it'll be the blueprint for a lot of people.
We could have a blueprint special edition. I'm writing it. We could collude, we'll get it out there. And
because we're speaking to the future of our nation. And these are the people we're going to be employing and building businesses. So it's super exciting. And we want to be known as a place where people can come to explore their options and understand what they do, right? So if people have businesses they want to buy or want some advice, feel free to reach out to us or yourself. Obviously, the book will be a pretty good place to start, but you've got a community yourself, Brandon, where people always are reaching out to you, and it's a safe place to do so. So we'd love to hear from you guys.
Yeah, perfect. Yeah, if anyone has any questions, they can ask me whatever, just on Instagram. Keep it easy. Yeah. I'm not selling anything.
Yeah.
So.
And you'll send them a nice long voice note.
Yeah. They all know it, man. Yeah, exactly. With a little instruction list underneath. Yeah, man. So they're all in it. I love it. I love the game, and it's a pleasure being here.
So good.